So we're chatting about investments, and we talked a little bit about equity investments versus debt investments. And now let's talk about the accounting for each of these. All right, we'll start with equity investments because these are pretty straightforward until they're not. But we'll talk about that. So let's get into talking about equity investments here. Equity investments. So here we're dealing with we have an ownership in a company. Now the thing with these, they don't have expiration dates. They don't have maturity dates. They don't. There's no guaranteed you're going to get any cash, right? We're investing in the growth of the company. Whatever we're investing in. So the accounting for this stuff is pretty straightforward. But as I pointed out in a previous video, the percentage of ownership you have might change the way you account for things. So if I have a small investment in the company, what's a small investment? Well, as long as it doesn't start going over 20% of the company, so anywhere from up to 20% ownership. Okay. The accounting for this type of equity investment is we're going to determine what's the fair value, and all changes to fair value go to the income statement. Okay? So if I own an equity investment, I may have bought it for $100, didn't have a huge ownership percentage. If that stock or equity goes up to $110, then I made $10 and that goes into my income statement. Now, these changes in the income statement, these are all unrealized gains. Or losses. And they're not taxable. They're not taxable. They only become taxable when I actually sell the security. Then if there's a gain, that becomes a taxable gain. But unrealized gains and losses, not taxable currently. May be taxable in the future. So these unrealized gains and losses are taxable in the future. They create deferred tax liabilities and deferred tax assets. Right? An unrealized loss or unrealized gain is going to create a future tax liability. And on my financial statements, I'm going to book this as a deferred tax liability. Right? I don't have to pay it now, but I am going to have to pay in the future, but it's conditional only upon when I actually sell the security. And unrealized losses create a future tax receivable. Right? Losses are going to offset any income that I had, and so just that loss is creating a deferred tax asset. Right? And in this course, I don't want to get too bogged down in trying to figure these things out, because there's all sorts of stuff in the financial statements versus the tax return that are going to be different. Certain things I'm going to handle in the tax return one way, and the financial statements I'm going to handle another way. And this is an example. And this is a nice, clean example that shows you how these two kinds of unrealized gains and losses go on the income statement for financial reporting, but they don't go on the tax return. They only go on the tax return when we sell this for cash. So this is just, I just want to at least give you a quick demonstration of, you've seen this deferred tax liability, deferred tax asset. A deferred tax liability means I have a liability, but I don't have to pay it now. I'm going to have to pay it in the future. Whereas a deferred tax asset is, I have a receivable from the government. I'm not going to get it now, but I'm going to get it in the future when whatever event happens, like selling it for a loss. When that happens, then I get my money from, or reduce the tax liability to the government. So just want to give you an example of both of these, both a deferred tax liability and deferred tax asset. So this is the simple rule if you own 20%, up to 20%. If you own, say, 10 to 20% ownership, or you own 20 to, we'll say 50%, and we'll make that clear, 49.9%. So you own 10 to 20 ownership, or you own 20 to 49.9%. But with this 10 to 20% ownership, you also have a board seat or significant influence. The accounting when this happens is what we refer to as equity method accounting. Equity method accounting, right? So as you kind of move into the ownership, you start doing different methods of accounting. This method here is fair value change in fair value of the income statement. Then if you have significant board influence or significant influence, board seat, significant influence, or you own more than 20%, but not more than 50%, then you have this equity method accounting. And in the next video, we're going to chat about a little bit more about what is this equity method accounting.